If you opened your trading terminal this morning, February 4th, 2026, expecting the usual rhythmic pulse of the markets, you were met with a silence that was louder than any crash. At exactly 6:47 a.m. Eastern Standard Time, as the sun was barely kissing the skyscrapers of Manhattan, the data feeds didn't just tick down, they stopped breathing. Most observers, the ones still tethered to the mainstream narrative of market cycles and technical adjustments, likely scanned the wires looking for a reason. They wanted a headline about inflation, a Fed pivot, or perhaps a minor correction after the volatility we saw 2 weeks ago. But what happened at 6:47 a.m. was not a correction. It was not a price adjustment. It was the first volley of shots fired in a global supply war that has been brewing in the shadows since the Nixon administration closed the gold window in the 1970s. Imagine the scene. The executives of the world's largest primary silver miners, the men and women who actually deal with the grit, the diesel, and the hard physics of pulling metal from the earth, stopped looking at their spreadsheets and started looking at the reality of the vaults. They looked at the Comex. They looked at the London Metals Exchange. They looked at a paper price of $78 per ounce, a number conjured by algorithms and high-frequency trading desks, and they compared it to the dwindling physical reality in their warehouses. Then, they said a single word, a word that is currently echoing through every bullion vault from New York to Shanghai, reverberating off the walls of the LBMA and sending chills through the halls of JP Morgan. That word was no. Not a single ounce. Not one refined bar, not one shipment of door bars rolling out of the smelters in Mexico, the deep mines of Idaho, or the high desert operations of Nevada. As of this morning, the trucks have stopped moving. The supply chain, the very artery that keeps the paper markets alive by providing the illusion of infinite liquidity, has been severed at the source. This isn't just a pause or a delay. This is a structural blockade. If you think this is just executive posturing for a quarterly earnings call or some desperate attempt to pump a stock price, you haven't been paying attention to the mathematics of depletion that have been screaming at us for years. The system didn't break this morning. It finally ran out of lies to tell. The catalyst was Keith Neumeyer, the CEO of First Majestic Silver. He didn't send a polished, sanitized press release through investor relations. He didn't wait for a curated interview on a cable news network that would have diluted his message with balanced commentary from a bank analyst. He posted a direct video statement to his company's website. It wasn't diplomatic. It was a declaration of economic warfare. He stated clearly that First Majestic will withhold all refined silver production from the spot market, effective immediately. His logic was as cold and hard as the metal he mines. Why should stockholders subsidize a rigged pricing mechanism that values a finite, non-renewable asset below the all-in sustaining cost of extraction? For decades, the miners have been the price takers, subservient to the price makers in the paper pits. Today, the roles reversed. Neumeyer set the floor, $150 per ounce. Until that number appears on the screen, the silver stays in the ground, or it stays in the vaults. By 7:12 a.m., Hecla mining followed suit. By 8:30 a.m., Endeavour Silver joined the strike. By the time the opening bell rang at the NYSE, the primary silver mining industry of North America had effectively gone dark. We are no longer talking about price discovery. We are talking about supply survival. The system has maybe 72 hours of inventory left before the force majeure clauses, those in case of emergency, glass boxes and legal contracts, start getting smashed. The trucks aren't coming, the vaults are empty, and the paper claims are about to find out that you can't build a solar panel or a 5G network out of a digital contract. This is the end of the paper illusion. Welcome to the real world. To understand the sheer scale of the catastrophe facing the bullion banks right now, you have to move past the headlines and look at the clock. In the world of high-frequency trading, seconds are an eternity. In the world of physical mining, hours define the survival of an exchange. What we witnessed this morning was not a series of coincidental announcements. It was a synchronized, multi-billion-dollar inventory strike. Let's trace the timeline of the dominoes falling, because the speed of this escalation is what has left the Comex floor in a state of paralysis. At 6:47 a.m., Keith Neumeyer of First Majestic set the spark. But a spark only becomes a firestorm when it finds fuel. At 7:12 a.m., exactly 25 minutes later, Hecla Mining, one of the oldest and most respected names in American silver production, released an identical policy. They didn't just support First Majestic, they mirrored them. The message was clear. The silver produced in the silver valleys of Idaho was no longer for sale at $78. By 8:30 a.m., as the pre-market brokers were frantically dialing their contacts in Vancouver and Mexico City, Endeavour Silver confirmed they were joining the strike. At this point, the leak in the supply chain had become a gash. But the final blow, the one that turned a localized protest into a global embargo, came at 9:15 a.m. That was when the heavyweights moved. Kerr Mining, Mag Silver, and Pan American Silver, all quietly, yet firmly, updated their quarterly guidance. They didn't need flashy videos, they simply informed the market that their refined product was being moved into temporary storage pending market stabilization. Do you understand what that means in plain, unvarnished language? It means the producers have gone on strike, not the workers in the pits, but the owners of the metal. It means the flow of physical silver, the lifeblood that travels from the mines to the refineries, and finally into the Comex registered vaults in New York and Delaware, has been shut off at the valve. Imagine the Comex as a giant bathtub. For decades, the bullion banks have been sitting in that tub, splashing around with paper contracts, confident that the faucet was always running. They didn't care how much water, physical silver, they let out of the drain because they knew the miners were constantly pumping more in at the top. But at 9:15 this morning, the miners reached out and turned the handle until it snapped. The faucet is dry. And the drain? The drain is still wide open. The mathematics of this inventory strike are brutal. Most people don't realize that the registered silver on the Comex is not a static pile of treasure. It is a working inventory. It is in constant, frantic circulation. Every single day, metal has to arrive to replace the bars that are being withdrawn for industrial use or private delivery. If that replacement flow hits zero, which it just did, the entire system enters a terminal countdown. According to the data I am seeing, the system has maybe 72 hours of working inventory left. Once that buffer is gone, we enter the territory of force majeure. For those who don't speak legalese, that is the act of God clause. It's what happens when an exchange has to look a buyer in the eye, a buyer who has already paid for their metal, and say, we have the money, we have the contract, but the metal simply does not exist. When those clauses start getting triggered, and they will, likely by the end of the week, the contracts that were written under the arrogant assumption of infinite supply will be revealed as what they truly are: worthless pieces of digital paper. Keith Neumeyer's quote should be archived and studied in every economics classroom for the next 100 years. He said, "Our stockholders did not invest in this company to subsidize a rigged pricing mechanism that values our finite asset below the all-in sustaining cost of extraction." That is the sound of the price taker becoming the price maker. The miners have realized that the Comex needs their silver infinitely more than they need the Comex's paper dollars. If the exchange wants First Majestic silver, the conversation no longer starts at the rigged $78 price. It starts at $150. Until that number flashes on the screen, the trucks stay parked. The smelters stay silent. The metal stays in the ground. The valve is shut, and the bathtub is almost empty. Before we look at the inventory math that proves this isn't a bluff, I need you to understand the invisible hand that isn't Adam Smith's, it's the algorithms. If you are wondering why this isn't the lead story on Bloomberg or the breaking news banner on CNBC, it's because the financial establishment is currently in a state of absolute, unmitigated panic. The algorithms that control what information reaches your feed are programmed with a single, overriding directive: protect the narrative of infinite paper liquidity. They are designed to suppress any content that exposes how the fraud actually works. I saw this 2 weeks ago when my warnings about the February crash were buried under a mountain of everything is fine fluff. The system cannot afford for 3 million short sellers to see the warning signs at the same time. If they did, the exit door would catch fire. The only way we break through this suppression, the only way we reach the people who are about to get margin called into oblivion, is through engagement velocity. I'm not asking for likes because I need the ego boost. I'm telling you that if we don't force this data onto the trending feed in the next few minutes, it gets shadow banned into the misinformation bin. Why? Because the truth about the silver inventory is a death sentence for the paper market. Let's expose the con that nobody in the mainstream media wants to touch. As of the close of business yesterday, February 3rd, the Comex reported registered silver inventory, the actual metal that is available for delivery against contracts, at 41.7 million ounces. On the surface, to a casual observer, that sounds like a lot of silver. It's what shows up on the CME website, and it's what the talking heads use to reassure the public. But here is the magic trick. Registered inventory is not a static pile of bars sitting in a dusty vault like the ending of an Indiana Jones movie. It is dynamic. It is in constant, rapid circulation. Think of it as a blood bank. Every single day, metal moves from registered status to eligible status as it gets earmarked for delivery. To keep the patient alive, new blood, refined silver, must flow in every single day to replace what flows out. If that replacement stops, the patient bleeds out in a matter of days. And where does that replacement metal come from? It doesn't appear out of thin air. It comes from the miners. It comes from the door bars that get refined into London good delivery standards and shipped to the warehouses in New York and Delaware. The baseline flow? North American production alone accounts for a replenishment rate of roughly 2 to 3 million ounces per month. The reality at 6:47 a.m. That flow didn't just slow down, it went to zero. This is where the math gets ugly. We can actually model the collapse of the paper to physical ratio using a simple deficit formula. $, text total available supply equals text current registered, text physical delivery demand plus text, inventory leakage, $. When the inflow from miners is removed from the equation, the inventory leakage, the metal leaving the system for industrial use, becomes an unpluggable hole. We are currently looking at an open interest in the March 2026 silver contracts of 73,000 contracts. Since each contract represents 5,000 ounces, that is 365 million ounces of paper claims floating around in the ether. Even if only 5% of those contract holders, the smart money who sees the miner strike for what it is, decide to stand for physical delivery instead of settling for paper cash, that creates a demand for 18 million ounces. 18 million ounces of demand against a free float of metal that is likely closer to 15 million ounces. Once you subtract the metal already tied up in leasing arrangements with bullion banks, the math is undeniable. Demand is greater than supply plus zero inflow equals systemic default. The paper price of $78 is a ghost. It is a price for a product that is no longer being delivered. The system is currently running on fumes, and the only reason the price hasn't hit $150 yet is that the algorithms are still trying to sell paper silver to people who don't know the mines have closed. The miners have finally figured out that they are the only ones holding real atoms in a world obsessed with digital bits. They've stopped playing the game. And now, the infinite paper liquidity narrative is about to hit the brick wall of physical reality. I've given you the math of the Comex, but I know how the human brain works. When you hear millions of ounces and paper-to-physical ratios, it can feel abstract like a video game where the numbers don't really hurt anyone. But there is a place where the mathematics of depletion becomes very real, very fast. I need you to perform a piece of field intelligence today. I want you to step away from the screen, find the nearest local coin dealer or bullion shop, and walk through their front door. Don't look at the digital spot price ticker they usually have running on the wall. That's just a decorative light show at this point. Instead, I want you to ask the owner two specific questions. These are the only two questions that matter in a supply war. What is your actual premium on physical silver right now? Not the spot price, but the all-in price to walk out with metal in your hand. How long is the wait time for a bulk order of 500 or 1,000 ounces? Because here is the secret the mainstream media will never tell you. The paper price and the physical price have officially decoupled. The $78 price you see on the news is a ghost. It is a price for a delivery that isn't happening. The real price is the physical price, and the physical price is the truth. We are seeing a massive spread opening up between the digital illusion and the physical reality. This isn't the first time the paper market has lied to our faces. We have a playbook for this. In 2008, during the height of the great financial crisis, the paper price of silver crashed to $9 per ounce. It looked like a fire sale. But if you actually went to a dealer, the premium was $8 over spot. You couldn't buy an ounce for less than $17. The paper market said crash, but the physical market said shortage. In 2020, when the world locked down, the paper price hit a measly $12. Again, the screen said sell, but in the real world, you couldn't find a single silver bar for less than $25. The pattern is clear. When the system breaks, the paper price is used as a tool to shake out weak hands, while the smart money hoards the physical supply. But those previous events were mere tremors. What happened this morning at 6:47 a.m. is the big one. The mainstream financial press, the Bloombergs, and the CNBCs of the world will keep showing you the $78 price. They have to. Their sponsors are the very bullion banks that are currently bleeding out. They will pretend everything is fine, while the dealers are quietly quoting March delivery at $100 per ounce. They will call it a temporary supply chain glitch. It is not a glitch. It is a structural failure. If the miners are withholding supply at the source, that scarcity doesn't hit the Comex first, it hits the retail level. It's like a river drying up. The people furthest downstream are the first to see the mud. You, the retail investor, are the downstream. This is why I need your help. I am one man with a terminal, but Miles Macro is a community of millions. I need your field intelligence to build a real-time map of this shortage before the official statistics are scrubbed or adjusted for public consumption. Go to the comments right now. I want to see a crowdsourced intelligence report. Tell me, your city, state, country, the dealer you visited, the premium they quoted, the wait time they gave you. We are building the truth map. When the world realizes that the spot price is a fiction and that there is no metal available at any price under $120, the panic will move from the coin shops to the industrial giants. But for now, the signal is clear. The paper market is lying to your face, and the physical market is screaming the truth. The trucks have stopped, the shelves are emptying, and the great decoupling is no longer a theory. It's the new reality of 2026. If you want to find the ground zero of this conflict, you have to go back to 2015. At that time, silver was trading at a soul-crushing $14 per ounce. Meanwhile, the all-in sustaining cost, AISC, for most primary silver miners, the actual cost to keep the lights on, pay the miners, and replace the equipment was averaging around $17 per ounce. Let that sink in. For years, the market was telling the people who produce the world's most essential industrial metal that their work was worth less than it cost to perform. The paper architects in London and New York were telling the miners to subsidize the global economy with their own balance sheets. The market gave them a clear set of instructions. Shut down production, stop exploring for new deposits, go bankrupt or diversify into something else. And for a long time, the miners had no choice but to listen. Between 2016 and 2020, global primary silver mine production dropped by 11%. That's not just a statistic. That is a massive chunk of global supply that simply vanished because it wasn't economically viable to dig. The juniors, the small exploration companies that find the mines of tomorrow, went bust. The majors slashed their capital expenditure, to the bone. They stopped looking for silver. To survive those lean years, the mines that stayed open did something desperate. They began high grading. They mined the easy stuff, the surface deposits, with $20 ounces per ton grades just to stay solvent. But you can only play that game for so long. When you eat the filet mignon of an ore body first, you're eventually left with the gristle. By 2023, the consequences of this neglect started to show. As ore grades dropped, the cost to process each ounce rose. Then came the inflation of 2024 and 2025. Energy costs doubled, labor costs spiked, regulatory compliance became a nightmare. By the start of this year, the average AISC for primary silver had climbed to a staggering $90 per ounce. The equation of economic suicide. $, text. Revenue $78, text. Production cost $90 equals $12, text per ounce, $. When the Comex algorithms crashed the price to $78 2 weeks ago, they didn't just hurt the miners' feelings, they threatened their existence. Every single ounce a company like First Majestic or Hecla ships to the Comex at $78 is a $12 loss. Every shipment is a destruction of shareholder value. Keith Neumeyer and his peers realized that they were being asked to commit corporate harakiri to keep the paper-silver charade alive for another quarter. They realized that for 50 years, ever since Nixon closed the gold window in 1971, they had been price takers, slaves to a digital screen. If you think the miners are bluffing, I want you to go to the CME website right now. Look at the Comex warehouse inventory reports under the category called Received. This is the data point that tracks new metal flowing into the vaults from refineries. November 2025, $4.2 million ounces. December 2025, $3.8 million ounces. January 2026, $2.9 million ounces. The flow was already hemorrhaging. The miners have been quietly pulling back for months, waiting for the price to reflect reality. This morning's announcement wasn't the start of the shortage, it was the official confirmation of a supply collapse that was already underway. The bullion banks thought they could print infinite paper to suppress the price forever. They forgot one thing: you can't print a silver atom. The miners have finally stopped being victims and started being predators. They've drawn a line in the sand at $150, and they have 10 years of accumulated resentment backing them up. There is a fundamental misunderstanding about silver that exists in the minds of most retail investors and almost every mainstream economist. They treat silver like gold's little brother, a speculative asset that people hoard in safes and look at when the dollar gets weak. But silver is not just money. In the year 2026, silver is the indispensable oxygen of industrial civilization. Unlike gold, which is mined, refined, and then stored in a vault for eternity, silver is consumed. Approximately 70% of global silver demand is industrial. It is used in microscopic quantities in almost everything that makes modern life possible. Solar panels, 5G switches, electric vehicle EV components, RFID chips, medical devices, and high-end electronics. And here is the terrifying part. Once it is used, it is effectively gone. Because the amounts used in a single smartphone or a single solar cell are so small, it is currently not economically viable to recycle it. It ends up dispersed in landfills. This means that every single year, the world must have a fresh injection of newly mined silver just to keep the lights on. Let's look at the green energy transition, the grand narrative that every Western government has bet their future on. Solar power is the backbone of that transition. But you cannot make a solar panel without silver paste. It is the only metal with the electrical conductivity required to turn sunlight into a moving current efficiently. The solar industry alone consumes approximately 100 million ounces of silver per year. That is a massive, non-negotiable chunk of global production. For a decade, these manufacturers have operated on a just-in-time, JIT, inventory model. They don't keep 6 months of silver in a warehouse. They buy what they need for next week's production run, assuming the Comex price will stay suppressed and the supply will always flow. That assumption died at 6:47 a.m. this morning. When the miners withhold supply, the JIT system doesn't just slow down, it shatters. If a solar panel factory in Germany or a 5G chip plant in Taiwan can't get their weekly shipment of silver conductors, the entire assembly line stops. You can't substitute copper. You can't use aluminum. Without silver, the green revolution is just a collection of expensive glass and plastic. We don't have to speculate about this. The warnings are already here. Last week, the United States Mint announced they are rationing the production of silver eagles due to planchette shortages. Planchettes are the silver blanks used to strike coins. The Mint gets these from refineries, and the refineries get their feedstock from, you guessed it, the miners. If the government of the United States cannot source enough silver to strike a 1-ounce coin, how do you think Apple is going to fare? How do you think Tesla is going to secure the silver needed for their EV power inverters? While the West has been playing games with paper derivatives and leasing silver to manipulate the price, China has been playing a different game entirely. China is the world's largest importer of physical silver, taking in over 200 million ounces per year, but China doesn't buy silver on the Comex to trade it. They buy physical silver through the Shanghai Futures Exchange and direct purchase agreements with miners in Mexico and Peru. They take delivery, they put it in government vaults, they treat it as a strategic resource, like oil or rare earth metals. China is watching this supply war with a smile. They know that if the Western miners stop shipping to the Comex, the Western industrial base will starve. And China, with its massive physical stockpiles, will be the only player left with the fuel to run the high-tech economy of the late 2020s. They are already recalibrating their strategy to prioritize shipments from miners who are willing to bypass the dollar-denominated Comex and trade directly in yuan or through the BRICS settlement system. The green illusion was built on the back of cheap, suppressed silver. This morning, the miners took the silver back. The industrial users are now facing a choice: pay the $150 price tag the miners are demanding, or watch their industries grind to a halt. There is no third option. There is no substitute. There is only the reality of finite atoms in a world of infinite digital promises. To understand how fast the Comex will disintegrate, you have to understand the burn rate. The exchange relies on a constant inflow to survive. Without the miners, that inflow is dead. Here is how the dominoes fall from today, February 4th, 2026. In the first 7 days, the registered inventory on the Comex, the metal actually available for delivery, will begin to bleed. We will watch it drop from 41.7 million ounces down to roughly 35 million. On the surface, the mainstream media will stay quiet, but beneath the waves, the algorithms will start to flag the anomaly. The first real sign of panic won't be the price. It will be the silver lease rates. Usually, it costs next to nothing to borrow silver, maybe 20 basis points. But as the bullion banks realize the miners aren't shipping, they will scramble to source metal to cover their own delivery obligations. Watch for lease rates to jump from 20 basis points to 200 basis points overnight. That is a 1-0-fold increase in the cost of carrying a short position. The hedge funds that were shorting silver at $90, thinking they were smart, are about to get their first taste of the meat grinder. Some will cover. The price will tick up to $82 on technical short covering. The media will call it a relief rally. They are wrong. It's a death rattle. By the second week, the inventory crosses the 30 million ounce threshold. This is the psychological red line. At this point, the U.S. Mint will announce a total suspension of Silver Eagle production. Local dealers will start reporting premiums of $15 to $20 over spot. Refineries will start issuing force majeure notices to industrial customers like solar panel manufacturers, citing a lack of feedstock. This is when the phone calls start. The U.S. Treasury calls the CFTC. The CFTC calls the CME Group. They will hold an emergency meeting with the bullion banks, JP Morgan, HSBC, etc. The banks will call the miners Keith Neumeyer and the others offering incentives to release their inventory, and the miners will give the same answer they gave at 6:47 a.m. This morning, the price is $150. Call us when the screen matches reality. The price breaks $90, then $100, then $110. The mainstream media cannot ignore it anymore. CNBC will bring on a senior analyst from Goldman Sachs who will claim this is a short-term supply disruption and that prices will normalize soon. But the smart money, the guys who have been stacking physical since 2020, won't be selling. They see the writing on the wall. They know that once the paper market breaks, there is no ceiling. The smart money is holding for $200, $300, or higher. The spread between the paper price, $110, and the physical price, $140, will widen into a canyon. By the end of February, the Comex registered inventory will drop below 20 million ounces. This is the point of no return. The March 2026 contract delivery demands will officially exceed the available physical supply. The CME will be forced to make the announcement that every paper trader fears. All silver deliveries will be settled in cash at the official settlement price. This is the act of God moment. This is a default. The moment that announcement hits the wires, the price will go limit up. It will gap from $120 to $160 in hours because every leveraged short position on Earth will try to cover simultaneously, and there will be zero metal available to facilitate the exit. Physical coins will be selling for $200 plus on eBay. The ETFs, like SLV, will trade at massive premiums because nobody trusts the underlying metal anymore. Trading halts will be implemented by regulators, but the black market for physical silver will continue to climb. The people who trusted the Comex price will be left holding a check for cash settlement that buys them 40% less silver than they were promised. The people who listen to the miners and to this channel will be watching the greatest wealth transfer in history from the safety of the sidelines. The math doesn't lie. The inventory is dropping, the inflow is zero, and the clock is at 11:59 p.m. I need to be very clear about what I am telling you to do right now. I am not telling you to run to a dealer and pay $200 per ounce for a silver eagle because of FOMO. Panic is not a strategy. I am telling you to look at what the miners are doing and ask yourself why. Why would the CEOs of multi-billion-dollar companies risk a shareholder revolt by withholding inventory? Why would they sacrifice quarterly revenue to make a political point? The answer is because they know the asymmetry of the situation. They know that $78 silver is a lie, and they know that once the paper market breaks, the re-rating of their assets will be historic. While physical silver is the ultimate insurance policy, the generational wealth move right now is in the mining stocks. Here is the math of the leverage that the mainstream analysts are missing. If silver moves from $78 to $150, that is a 92% increase in the price of the metal. But for a miner, the profit explosion is much larger. Let's look at the margin calculation. $, text profit margin equals text silver price, text all-in, sustaining cost, AISC, $. At $78 silver, $78, $90 equals $12, the company is losing money on every ounce. At $150 silver, $150, $90 equals plus $60, the company is now generating massive free cash flow. The move from losing $12 to earning $60 is not a 92% increase. It is an infinite percentage increase in profitability. This is how a stock price goes from $5 to $50 in a matter of months. You are buying the leverage to the supply side at the exact moment the supply side has weaponized itself. However, you cannot just buy any mining ETF and expect these results. You need to be a surgeon. Hedged miners. These companies sold their production forward at $70 or $80 to secure bank loans. They are locked in. They don't benefit from the move to $150 because they've already sold their silver to the banks at the old prices. Unhedged producers. These are the warriors. They have zero forward sales. They have 100% exposure to the spot price. These are the companies like First Majestic and Endeavour Silver that just declared the strike. As we close this broadcast, let's recap the reality of February 4th, 2026. The strike, the world's largest primary silver miners, have stopped shipping to the Comex. The floor, they have set a hard price floor at $150 per ounce. The deficit. The Comex has no replacement flow and is facing a delivery default within 30 days. The reset, the paper pricing mechanism is dead. Physical supply and demand are taking over. This is the moment we have been waiting for since the 2011 bull market died. The miners have taken back the power. The only question is whether you are positioned or whether you are watching from the sidelines with a bank account that is being inflated away while the real world resets its prices. I need you to do 3 things right now. Smash the like button. Force this data past the suppression algorithms. Subscribe and turn on notifications. I will be dropping an emergency video the moment the Comex registered inventory crosses the zero inflow threshold. Comment your field data. Tell me your city, your dealer, and the premium you are seeing. We are building the truth map together. The trucks have stopped moving. The clock is running. The data is in front of you. This is Miles Macro. Your move.